This week's number, 20 million. That's how many times Prof G listeners downloaded one of our episodes this year. That's the equivalent of every person in New York City, LA, Chicago, San Francisco, Houston, and Phoenix downloading one of our episodes. True story, after my dad's third wife left him, he moved to Arizona and lived with 2 prison guards. It's not a joke. That actually happened. Welcome to a special episode of Prof G Markets. It's our last markets episode of the year before we break for the holidays. So today we're reflecting on the market-moving stories that shaped 2022. First off, just a little bit of insight into our business, as I think there's some learning here. We launched Markets and No Mercy, No Malice as a podcast. I expect to eat CNBC from the bottom up. We will be seen as a disruptor that devours CNBC and then shits them out like a bad version of Bloomberg, or I'm trying to think of a financial news network that is struggling. Anyways, that was graphic. It's my colonoscopy. I just can't get past sort of the digestive system. But anyways, the lesson here is every year we try and find growth. And that is Catherine Dillon and I, my partner in the business, we thought about after selling L2, we didn't want to get back on the hamster wheel. We didn't want to raise money. We wanted to start a business that would be a nice business with good people that we liked working with, that were smart, and keep it small. And we've done that. But here's the problem. It's very hard to retain talented young people if you're not growing and developing something that has enterprise value. What do I mean by that? Young, intelligent, hardworking people have a lot of options, which is good. But what's bad about it is they have a lot of options. And so unless you're creating something that's growing such that they can make more money and develop economic security for them and their future families, you're going to lose them. And you might just want to keep a business small and have people rifle through. But this business has grown faster than we'd expected, and we realized we needed growth. And rather than launch a newsletter or try and figure out some sort of different medium, we've done TV. We are cursed with opportunities here. We decided to extend the Prof G franchise and start a Markets episode and a No Mercy, No Malice. So No Mercy, No Malice reading is something we really enjoy. I don't think it's going to be a big business, but it's something we enjoy, and it's modestly profitable. But the Markets brand extension, if you will, we think has real legs and is already almost as big as our core brand after just a few months. And I think young people are looking for sort of fun, irreverent, financial news information that is educational, and that's what we're trying to do here. Our mission is to help younger people be more economically and emotionally viable. So we're going to extend this franchise. We might go to twice a week. We might go to 3 times a week. We're not sure, but this has been essentially our growth vehicle. Now, what's the learning? About 97 or 98% of all incremental dollar volume at consumer companies is through brand extensions, not new brands. A rookie move is to start a new brand. But if you have something that's working and the Prof G franchise was working, it's much better to extend the brand. So in sum, Diet Coke is going to have a much easier time than launching Boobly or another type of brand or a new brand. So just as our strategic imperative for 2022 was to extend the Prof G franchise into No Mercy, No Malice and Prof G Markets, our strategic imperative for 2023 is to launch a more robust video version of Prof G Markets. We think there's a lot of opportunity for graphic overlays, videos, filming, Mia with her person on the street, showing Jason and Ed in their studios, but we want to kind of bring in a video dimension, and we want to attack business television from the ground up, and that is going through the podcast window and then overlay graphics and visuals as opposed to doing another business show. A long-winded way of saying we appreciate your support. We are continuing to grow the company. I think we grew at about 40, or our downloads about 40 or 60% this year, and we have the same plan for 2023. So thanks for a great year, and on to 2023. Ed, what are the headlines? Enough about Prof G. What's going on in the world outside of the Prof G empire?
Let's start with our weekly review of market vitals. Today we're taking a look at how the vitals moved throughout the entire year as opposed to just the week. The S&P 500 started 2022 at a record high on the first trading day of the year. By the end of January, it was down 5%. And that pretty much set the tone for the rest of the year. It hit its 2022 low in October, off about 25%, and is now down around 15%. Meanwhile, the dollar had one of its strongest years ever. In the first 9 months of the year, the dollar rallied 20%, reaching a 2-decade high. It has since given up about half of those gains. Bitcoin's plummet this year was spectacular. The cryptocurrency began 2022 at $48,000, fresh off its all-time high of $68,000 in November 2021. Exactly 1 year after setting that record, though, the coin hit a 2-year low of $15,800 amid the FTX fallout. That's a 77% collapse. As the Fed aggressively raised interest rates, the yield on 10-year treasuries climbed. The yield on 2-year treasuries, however, rose even faster. This caused something called a yield curve inversion, where the yield on short-term government bonds is higher than on long-term bonds. The inverted yield curve is notoriously a recession indicator. It expresses more risk in the short term versus the long term, and today, the yield curve inversion is at its deepest level in 40 years. Scott, this has felt like a crazy year for markets, to me at least, but that might be, one, because I'm young, and two, I'm also paying more attention now. Have you ever seen a year like this before?
Well, some aspects of the year have been over-dramatized. So people under the age of 36 have never really seen a bear market. And so there's a lot of the sky is falling kind of rhetoric right now. And as someone who was in their starting businesses in the 90s and experienced, and I was starting e-commerce companies in the 90s, and then 2000 came, and it was literally as if a tap got shut off. I used to go to the World Economic Forum, and when I went in 1999, I was treated like a god. All these masters of the universe wanted to meet me and get insight on how their big businesses could be transformed into internet companies. And then by 2001, when I went back for the third time, I felt like a pariah. And people were looking at me as if I was some sort of criminal. And the correction was so violent, and business just collapsed, and the markets collapsed. And then again in 2008, people forget that the markets really, I mean, this has been an Easter picnic compared to what happened in 2000 and 2008, except maybe for some growthy stocks. But the reason they collapsed is they just got so out of control. The thing that is different this time is this mania resulted in a series of asset classes and vehicles that felt really Ponzi-like, sort of near fraudulent, whether it was crypto or Web3 or someone who doesn't shower, moving to the Bahamas and not having a board or audited financials. Even a quote-unquote well-respected hedge fund manager, Kathy Wood from ARK, coming out now, even now, just last week, and saying, doubling down on her price target of $1 million for Bitcoin. I find that reckless. I find that irresponsible. There's just no way she can make any sort of cogent argument, and she hasn't, as to why she believes this asset is going to go up 60-fold. It's just resulted in a level or a cloud cover, whether it's SPACs that have been largely nothing but a transfer of wealth from retail investors to the sponsors of those SPACs, to Web3, which is, again, see above, been a levered Ponzi scheme. The companies in 99 that went down were sort of consensual hallucination, but they weren't fraudulent. They were publishing their numbers. And so I've never seen this type of grift before, or what I'll call legal grift, whether it was Adam Neumann claiming it was a tech company, Theranos, these ridiculous levered crypto Ponzi schemes, and that's exactly what they were. I haven't seen that before. I haven't seen it in my career.
Okay, let's move on to our first story. The biggest story this year was probably Ukraine. Vladimir Putin announced a full-scale invasion on February 24th, which immediately impacted markets around the globe. The first to get hit were the currency markets. The Russian ruble collapsed, then quickly rebounded, and the US dollar went on to have one of its strongest years in history as investors around the world flocked to safety. The greatest effects, though, were felt in the energy market. Russia restricted its oil and gas supplies, which sent energy prices around the world soaring. Energy was the best performing sector of 2022, up more than 50% compared to the S&P's 15% decline. I want to jog your memory, Scott, and go back to the early days of the war. So here's a clip from the Prof G pod in March.
Look, I'd like to think that the West are a moral people and that the death and destruction that's occurring in Ukraine weighs on everyone and is a real motivation to try and do what we can to get the tanks out and stop this conflict. This thing has been the great ferocious Russian army has been diminished from a perception standpoint. There is, for the first time, purpose with NATO, which was near brain death as far as I could tell. Republicans and Democrats are even getting along for the first time. It feels as if, while there's tremendous costs being borne by the Ukrainian people, that every day this continues, geopolitical advantage perception is ceded from Russia to the West.
Scott, it's been 10 months since this all started. What's been your main markets takeaway from the war in Ukraine?
Well, it's the stuff you don't expect that gets you. So the moment Europe began running all sorts of stories about the pending energy crisis in the winter and how people wouldn't be able to heat their homes and it would send Europe into recession, it's the stuff you're really worried about that doesn't happen. And it makes sense. If you see, tall grass is shaking and all you can think about is there must be a lion behind it, there usually isn't. The line that gets you is the one you're just not expecting. And remember all the noise around Greece and its economy collapsing and how it would create contagion. I just felt like we were talking about it forever. No one was expecting this. No one saw it coming. And the fact that Putin going into Ukraine could cause or set off this type of inflation through food and energy supply chain interruptions, to me that was, it's sort of, the world has its plans and then God laughs. I thought it was really interesting and how important it is for unity across the West. And I think that's the story of 2022.
Let's move on to our second story. 2022 was the year we all became macroeconomic experts. And that was for two big reasons: inflation and interest rates. Prices across the globe soared this year. From Germany to the UK to the US, many nations saw their highest inflation in decades. Here in America, prices rose as much as 9% from a year earlier, before cooling down to roughly 7% inflation in November. In response, the Fed took forceful action. Fed Chair Jerome Powell raised interest rates at the fastest pace in 40 years, with a target rate of roughly 4.5%. This increased borrowing costs and costs of capital, it tightened demand, and it sent chills through the stock market. Scott, on the very first episode of this show, we discussed interest rate hikes. Here's a clip from July 18th.
I'd be shocked if we didn't see a 100 basis point increase from the Fed. And I don't think there's any signal that they're going to slow down for fear that they're going to cool the economy too much. People are spending money. We also have unemployment at record lows, historical lows, still a ton of jobs out there, still multiple jobs available for every person looking for a job. So I don't think he's worried about putting us into a hard landing or a depression.
So rate hikes have been aggressive, but not 100 basis points aggressive. How has your stance on interest rates changed, Scott, if at all?
I think they've done exactly the right thing. I mean, you could argue that they were a little bit late. The interest rate increases have been pretty dramatic, relatively speaking. And that is, interest rates as we sit here today aren't historically high. They're kind of average to maybe even a little bit below average. And so when Chamath Palihapitiya says that the reason SPACs have crashed 90% is because of Jerome Powell's increase in interest rates, that's just total bullshit. The reason that SPACs have crashed is that these companies are shitty companies that were not subject to any sort of disclosure. And because there wasn't a quiet period or isn't a quiet period with SPACs, people who are charismatic and articulate, as Chamath is, can go on CNBC, which he can do, which the CEO of a company about to go public can't, and feed the gristmill of, tulip mania / just ridiculous hysterics that a stupid company, Virgin Galactic, is going to be, is worth several $billions. This company's going to zero. Space tourism makes absolutely no sense, or as does Clover Health is a shitty business. My favorite is this most recent SPAC he took public, a software company or a video game company that was going to help treat kids' ADHD. That is the perfect SPAC company. A company built on a wing and a prayer, but it sounds really cool and shouldn't be subject to the scrutiny of the SEC. So I think the interest rate increases were overdue. I think they are doing their job. I think Jerome Powell has done a good job. And this notion that we should do anything to avoid a recession, I don't think that's the right strategy. Jamie Dimon summarized it perfectly when asked what a recession was. He said something that happens every 7 years. It's good that housing prices are coming down. Young people deserve a shot at owning a home. And just because it erodes some equity of people who already own homes, there's no free lunch. Some people will get hurt. But young people, just as I had a chance to buy a house in San Francisco for $285,000, that's what my first house cost in Potrero Hill in 1994, I think. Young people got to get their shot. So let the gale force winds of disruption howl. I hope they increase interest rates to the point such that they bring down inflation. And also a prediction we've made is that inflation was going to come down as fast as it went up.
Mm-hmm. Yeah, I mean, inflation is still pretty high, though. It's at 7.7%. It was almost as high as 10% earlier in the year. And that sort of set the political tone this year. Everyone's been trying to answer this question of what is causing inflation. And people have been saying, oh, it's the stimulus payments, or it's supply chain issues, or it's the war, or it's price gouging. What do you think, now that we have some perspective? What has caused inflation?
Well, it's all of that except for price gouging, and I'll come back to it. So we had the perfect storm of inflation is too many dollars facing too few products. So on the supply side, you had a shock around supply chain with near total COVID lockdowns in China. We're still, up until I think last week, a quarter of the population was under partial or full lockdown. So fewer products, fewer grains, fewer barrels of oil because of the war in Ukraine. So supply shock. On the demand side, we took 27% of GDP and flushed it into the economy. $1 in $3 has been printed since COVID, so too many dollars facing too few products. Fairly straightforward. We set ourselves up for inflation. Some of it we could have seen or should have seen. Some of it was totally unexpected, and no one saw what was happening or going to happen in Ukraine. The notion of price gouging really bothers me, and that is companies have an obligation to their shareholders when times are good and they can raise prices. If Home Depot, in the midst of a hurricane, quintuples the price of lumber for rebuilding homes, that's price gouging. That's exploiting people. If you're taking hand sanitizer and hoarding it and marking it up 10x, that's price gouging. The real price gouging, though, that's taking place in America is probably across the medical industrial complex, where you can produce penicillin for 20 cents and you charge $10. Or you realize that insulin can, if you increase the price of insulin fivefold, they have no choice, and there's not enough competitors to bring the price down. That is price gouging. It's antitrust. It's monopoly abuse. But raising the price of oil because prices go up and oil companies finally have the chance to make money, that's kind of their obligation. And there are enough big oil companies such that it's a fairly competitive market. And when price went up, or when oil prices went up, or when gas prices went up 100 days in a row, there were 112 articles in the New York Times on it. When it went down 100 days in a row, which it did, or 95 of the 100, there were 12 articles on it. So this notion of price gouging, it's like, well, what do you mean exactly? Oil companies haven't made a lot of money. Their stocks got the shit kicked out of them in the previous 10 years, and then now they're making a lot of money, and that's called capitalism. So I don't buy this notion of price gouging across competitive industries. But this was the perfect storm for inflation. And now, in my opinion, we have the perfect storm for inflation to come down. We have an incredibly strong dollar, and in an import economy, which is what we are, things should get a lot cheaper, whether it's Pellegrino water or Toyotas, the prices of these goods should come down. Two, I think that we're going to see some sort of path to peace in Ukraine in 2023, and the markets will perceive that. We're already seeing oil prices come down. We're seeing energy prices come down. We're seeing the prices of chicken have plummeted. We're seeing the prices of containers on ships come way down. And interest rates will do its job and will dampen demand. So you have the reverse. You have more supply. We're seeing the supply chain get ungunked. We're seeing a reduction in demand, fewer dollars facing more products, which should result in a dampening of inflation. I think we're going to see inflation come down almost as fast as it went up.
All right, let's move on to our final story of the year. Nothing better summarizes 2022 than what happened to tech, venture, and crypto. In a word, pain. This was the year investors fled from growth assets, or as Aswath Damodaran calls it, risk capital, and they reallocated towards safer investments, specifically bonds and treasuries. As a result, the tech sector suffered unprecedented losses. In 1 year, shares in Google, Amazon, Meta, and Snap declined 30, 50, 70, and 80% respectively. Big tech shed more than $3 trillion in value, and these tech companies also laid off employees to the tune of tens of thousands. Meanwhile, crypto got crushed and startups struggled. US venture investment is down 50% from a year ago, and many hot private companies have suffered down rounds, i.e. raised money at lower valuations. Scott, I think you pretty much called all of this. Any reflections on this?
Well, we knew this was coming. We just didn't know when. The growth economy has gone from something like 7% of GDP to 12%. Companies kept on hiring even when they saw the growth was slowing. It's overdue. And even if you look at the S&P, it's now trading, I think, at a PE multiple of 15 or 16. So it's about average. And I think we're going to see additional pain. I like what Aswath said, that the story of 2022 is inflation and the story of 2023 is going to be the economy. And again, I think it's a good thing. And I think we're just getting going in terms of layoffs around the growth economy. The Patagonia Vest recession is what we have labeled it. I just would think it's impossible for the CEO of every tech company to not take notice of what Elon Musk has done at Twitter, and that is he's laid off 70 or 80% of the staff, and the site is still functioning. So they're probably going to think, well, could we thread the needle and not be, an incredible asshole and hold on to the majority of our revenues while potentially not necessarily firing 70 to 80% of our employees, but getting rid of 10 or 20%. So one of my predictions is that next year you're going to see Meta and Google's revenues slow, but they're going to register record profits, as I think they're going to decide that after 13 years of stuffing ice cream down the throat of these companies, that they've built up a lot of fatty deposits that they can work off, which is a kind of a fancy way of saying there are many more layoffs to come in 2023 across the growth economy.
If you were on the board of Meta, what would you be advising? Maybe, I assume layoffs is one thing, but how do they get themselves out of this hole net for 2023?
Well, first off, they don't have a board. They have a board of advisors, because when you have a dual-class shareholder company, and I've been on the board of dual-class shareholder companies, the New York Times, we would make very rational arguments, and then the family would go off and have Thanksgiving and decide what they were actually going to do or not do, and they could just ignore us. And that's the same. The same is true here. I mean, at least they have a pretend board at Meta, but I know a few of the people who've gone on this board. And whenever they're thoughtful, decent people concerned about the Commonwealth, they all have the same thing in common. They go on thinking that they can talk some sense into Mark Zuckerberg, and then they leave when they realize they can't, and they're not down with what is actually happening at that firm. So if he had a real board, the first thing I would do is fire Mark Zuckerberg. He's demonstrated an incredible disdain or lack of concern for the Commonwealth and for our youth and for our elections and our democracy. But given that that's not possible, the best you could hope for in terms as it relates to the stock price would be just to ramp down or eliminate these ridiculous big gulp ayahuasca vente grande investments in the metaverse. And that's why it's one of my stock picks for 2023, because as much as I dislike Meta, the market has severely overpunished Meta stock. And if you look at the accounting on their investments in the metaverse, they could have tried to categorize this as R&D or CapEx and then amortize those investments. Instead, they've taken the full charge on them, meaning the pain has already been incurred. And in the last 6 months, Meta's shares have given up all the gains for the last 5 years. It's now trading at a PE multiple that looks more like an old economy manufacturing company. And the moment they start reducing or exiting this consensual hallucination with Mark that these investments make sense, all of that immediately, all of those savings immediately drop to the bottom line. So $1 cut from the metaverse is like an incremental $2.50 in revenue, because if they have operating margins of 40%, in order to maintain profits, they have to grow. If they invest $1, they need $2.50. That's equivalent to $2.50 additional dollars in revenue. Or put another way, for every dollar they cut, it's like getting $2.50 in incremental revenue. So the moment they start to ramp down or rationalize these investments, the stock just, in my opinion, goes on a tear upward.
Yeah, Scott was mentioning the multiples. The enterprise value to revenue multiple of Meta is 2.5x right now. And compared to Snap's is 3.2, Pinterest is 4.6, so almost double. And Google, if you want to compare that, though it's not as good of a comparison, is 4.1. Where does Apple stand in all of this? Apple's market cap is now $2.5 trillion. It's more valuable than Google, Amazon, and Meta combined, and those are the four that you wrote about in 2017. What happens to Apple in 2023?
It's super interesting. I would have predicted that if there was going to be the one, I would have predicted it would have been Amazon because of their multiple businesses and cloud, and I'm a big fan of Alexa. And I got that wrong. It looks as if voice isn't paying off as quickly as they thought, and they're talking about cuts in the voice group or the Alexa group. Apple has just executed on every dimension. They figured out supply chain. They're really the only big tech company that has huge businesses in Western markets and in China. That's kind of the big difference. Google's not in China, right? Meta's not in China, but Apple is. So Apple has been able to capture huge business and market share in Western markets and in China. And Apple taps into the ecosystem that is the most robust, fastest-growing, luscious ecosystem in the world, and that is essentially the top decile of income earners globally. There's 1 billion iOS users. They're the 14% of the world's population. They're the wealthiest people in the world. You know, an iPhone is a month's salary in Brazil. It's probably 3 months' salary in Hungary. So it's a luxury item. But here's the thing, Ed. The top 10% in our economy have killed it. Every year, the top decile of income earners around the world continue to garner more and more of the world's GDP. And their premier product, their aspirational product, their go-to is iOS, specifically AirPods or the iPhone. And the iPhone is the first wonder of the capitalist world, and that is it has achieved what no other product has been able to achieve. And that is, it is the luxury high-priced product, but also the market share leader. And to just highlight what an anomaly this is, imagine if this was an automobile firm. What it would be Ferrari, the margins and price point of Ferrari, with the production volumes of Toyota. You just never see that. And so what you have with the iPhone is a company that's produced more gross margin profits than probably 90 of the top 100 consumer companies combined. We've just never seen a product like the iPhone. We've never seen execution by any individual like this. See above Tim Cook. Tim Cook has added more shareholder value than any CEO in history since taking over from Steve Jobs, where the market cap was $300 billion. He's added $2.1 trillion in value. We've never seen that from an individual. And a lot of people would say it's harder to go from 0 to 300 billion, and they might be right. But what Apple has achieved is nothing short of remarkable. Having said that, everything incurs a reversion to the mean. I would be hesitant to go long Apple right now because they've not only been good, they've been lucky. And everybody has their time in the sun, and everybody has their time in the woodshed. And I mean, Apple is a deep, deep copper tone brand. It's been so good for them for so long. I think that's hard, just through sheer probability. That's unlikely to last.
Thanks, Scott. Before we go, what are your major takeaways from 2022, and what do you hope young investors have learned this year?
Well, 2022 was sort of the year of inflation, but what it also was it looks as if we have mostly exited the pandemic. 2020 and 2021, I think, just took such a huge toll on so many people. So 2022, I think, will be seen as a good year for America. No one was lining up for Russian or Chinese vaccines. I think we said no to autocracy. The largest democracy in Latin America, Brazil, the institution is holding strong, peaceful transfer of power. I'm very heartened by the elections, the midterm elections, where every election denier, or almost every election denier, was not elected, where Trump's endorsement ended up being the kiss of death. And on average, anyone who was endorsed by Trump got, they estimate, 2.3% less votes than they would have had they not been endorsed by Trump. And I think in the media, and technically we're in the media, we have this both sidism where we try to understand Trump voters. I think you're voting for someone who is been probably the worst thing for America in the last, 50, 100 years, forever. So I think that our flirtation with autocracy has come to an end in 2022. I think that was really positive. In terms of what young people can take away, there is no easy money. And while at your age it's fine to take risks that have asymmetric upside, have some fun, the key is low cost, diversification, and then not day trading. And the way you make a lot of money is you get very focused on your work. If you have a side hustle, it means your main hustle isn't working and you should get another one. You work hard, you try and go from being good at something to great at something. You try and spend less than you make, and you put it away in diversified, low-cost ETFs and index funds, and you let time take over, because you're going to wake up and you're going to be staring into a podcast camera and think, how the fuck did I get this old? And it's going to happen really, really fast. And because I always attempted to save more than I earned, because I always attempted to diversify, I'm talented, I work hard, but the reason I'm economically secure is that I have been reasonably smart and rational about investing. And this is what I tell young people. Focus on your work very hard, try and save more than you spend, always put away a little bit of money. Don't put all of your money into any one asset class, regardless of how good it looks, and let time take over. So diversification, focus on your talent, live a little bit like a stoic, always try and save a little bit of money. And, in sum, I know how to get you rich. That's the good news. The bad news is the answer is slowly.
Thanks, Scott. Normally I'd ask for a prediction at this point in the show, but our listeners will have to wait till January 2nd when we return to Prof G Markets with an entire episode devoted to Scott's predictions.
So I have another PSA, public service announcement. I'm about to go on Stephanie Ruhle on MSNBC. I bring that up because I'm desperate for other people's affirmation. But I'm going to be talking about friendship, and I am just struck. My big kind of learning, if you will, in 2022 that has really shocked me is a crisis in loneliness and friendship. And there is new studies showing that 1 in 10 women and 1 in 7 men don't have a single friend. And it's a mix of factors. Polarization, we like each other less. We go on social media and we get angry at each other. COVID, not going to the mall, not going to work, not going to the movies. And I do think there's a real crisis of loneliness. And what I have asked my kids to do, what I'm going to try and do, although I'm not good at it, try and push the limits of your comfort zone and establish a friendship outside of your immediate circle. And there's very few investments you can make that have an immediate 100% return. And what do I mean by that? You will likely get reward from that relationship, and also they will. There are so many people who don't have friends. Marriage is on the decline, so there are so many people that don't have kin. There are so many people working from their homes that don't have the same access to a context to meet other friends, whether it's the office. A lot of young people miss their last 2 years in high school, their last 2 years in college. So I think we have an obligation to try and if we're in a position where we have the time and the energy and the resources to reach out to people and try and establish more bonds and more connective tissue around friendships. We look forward to seeing you in 2023. After you get through what is the most overrated holiday, New Year's, my suggestion, experiment with some sort of psychedelic and kiss someone strange.